A remarkable and yet concerning development in the banking sector is signaling the financial system is in big trouble. Severe imbalances between the volume of loans and deposits in all four of the U.S. biggest banks are indicating that the overflow of liquidity issued and pumped into the system by the Federal Reserve over the past 12 months is triggering operational problems for banks and setting the economy up for failure. The loan-to-deposit ratio is a measure of how much money printed by the central bank enters the bank system and how much money is created by private entities. The first being responsible for bad inflation, higher prices for assets and goods, lower growth, and the second by good inflation, boosting economic growth with real money. The largest U.S. bank, JPMorgan, just released its latest earnings report, in which it exposed that in the second quarter, its total deposits went up by a staggering 23% year-over-year to $2.3 trillion. On the other hand, the total amount of loans issued by the bank remained flat at $1.04 trillion. This means that more printed money is making its way into the financial system than real money is getting out and going into circulation across the economy. Moreover, the report highlighted that this is the second time in history that in the first quarter, JPMorgan recorded 100% more deposits than loans. In other words, the ratio of loans to deposits is now 50%. The last time such sharp imbalances between the volume of loans and deposits occurred was just before the Lehman crisis. So, this is a very alarming situation that financial analysts have been closely watching. However, for the Bank of America, this epic divergence is even worse. Deposits hit a new all-time high of $1.91 trillion, despite the fact that the bank's loans have continuously shrunk at a very alarming deleveraging pace and are sitting now at $927 billion, roughly $100 billion below their level just before the Lehman crisis. That is to say, Bank of America recorded zero loan growth for the past 12 years, while the bank's deposits have doubled. The same has happened to Citigroup and even Wells Fargo. Now, combining the data collected across the four big banks, analysts found something extremely worrying. There has been no loan growth in the United States since the global financial crisis, while total deposits have doubled. Simply put, for the past 12 years, only unbacked money was put into circulation. According to zero-hedge financial experts, there are two major implications resultant from the collapsing loan-to-deposit ratio. The first is that this ratio is a closely watched metric that measures how much lending a bank is doing when compared to its capacity to lend. The second is actually the most fundamental question in modern fractional reserve banking. What comes first, loans or deposits? Put it another way, do private commercial banks create the money in circulation by first lending it out? Or is the central bank the only one responsible for money creation? In face of all of the recent data, one thing is certain. At this point, there are far more deposits than there are loans in the U.S. banking system, and this is a major problem. Conventional monetarists argue that loans always come first, and only then do banks receive deposits. Even if that was the case somewhere in the past, it's certainly no longer the case right now. Deposits are coming first because the money supply has exponentially grown in the past year, and everyone knew that eventually this money would flood financial markets while also pushing up the price of assets, goods, and services to sky highs. For evidence, just note the recent explosion in consumer prices that readjusted inflation expectations to the highest in 13 years. In essence, the recent loan and deposit data mean that the conventional process of deposit creation via loans is terminally broken. So you might be wondering, what will be the main implications of all of this? Well, in sum, banks won't have another alternative rather than issuing a massive amount of loans to offset the massive amount of liquidity injected by the Fed into the financial system. So while bank deposits have already experienced the good effects of future inflation and have manifested it in the stock market, it's now the turn of the matching asset to catch up. In other words, banks will essentially flood the country with $2.5 trillion in loans, which account for a third of the currently outstanding loans, in order to catch up to the head start provided by the Fed. Most importantly, once banks release this huge lending effort, the inflation provoked by the Fed's policies will show its worst effects. In short, the excess deposits over loans in the financial system were entirely driven by the trillions of printed dollars pumped by the Fed, with quantitative easing directly serving to purchase assets from virtually everyone in the financial sector, with the result being a proportional increase in bank deposits, as sellers of assets, bought ultimately by the Fed, need a place to park their newly acquired cash, as the experts noted, adding that even as the Fed has pumped trillions in reserves into banks, which by transformation have ended up as deposits on bank balance sheets, the velocity of M2 money has plunged to an all-time low, as loan demand is nowhere near enough to offset the Fed's forced deposit creation, which incidentally ends up not in the economy, but in capital markets, resulting in broad deflation offset by asset price hyperinflation. Another critical reason why this data is so relevant is that the continued loan destruction is a sign of looming deflation, meaning that prices will stay up while growth will remain flat. So the inflation fueled by the Fed won't serve its purpose of actually stimulating the economy. That's what a flows and liquidity report from JPMorgan strategist Nick Panikurtzoglou, titled "The Challenge from Weak Bank Lending," has recently outlined. The strategist wrote that a common feature of this week's U.S. bank earnings reports has been the weakness in loan growth. Indeed, weekly data from the Fed's H8 release shows that the pace of U.S. bank lending remains in negative territory, exhibiting persistent weakness since last summer. This persistent weakness, as Panikurtzoglou explained, followed a temporary spike in bank lending during Q2 2020, immediately after the virus crisis erupted, and is reminiscent of the U.S. bank lending trajectory after the Lehman crisis. After a temporary spike immediately after the Lehman crisis, driven by companies and consumers tapping bank credit lines, the pace of U.S. bank lending has remained largely in negative territory up until the middle of 2011. Although it entered positive territory after 2011, the pace of U.S. bank lending had stayed significantly below pre-Lehman crisis levels, an important feature of the secular stagnation thesis. The JPM analyst then admits that it remains to be seen whether the protracted post-Lehman period weakness in bank lending would be repeated in the current post-virus cycle, even though what is likely to be the case is that the future trajectory for bank lending would be important in determining both the inflation and liquidity picture over the longer term. Panikurtzoglou stressed that a repeat of the post-Lehman period protracted weakness in bank lending would cast doubt to the idea of a sustained inflation impulse over the coming years. It would also act as a drag for money supply and liquidity creation going forward, reducing a key driver of asset prices. And he ominously concludes that whether the protracted post-Lehman period weakness in bank lending is repeated in the current post-virus cycle will be critical in determining both the inflation and liquidity picture over the longer term. So far, the trajectory for bank lending shows more similarities than differences to the post-Lehman crisis period. Up until now, banks have been investing more into securities, with all of those trillions in printed Fed cash, with a large majority of these securities being Treasury and agency securities, and banks are also investing more into agency mortgage-backed securities, MBSs, than into U.S. Treasury and non-MBS agencies. However, that doesn't mean this is stimulating growth or good inflation. According to Morgan Stanley, these investments won't show up in the inflation outlook because bank purchases of U.S. government debt do not add to the inflationary impulse of government spending beyond what the government spending itself did. In simple terms, Treasury securities on bank balance sheets don't represent credit or narrow liquidity creation. But bank purchases of agency mortgage-backed securities, which are similar in nature to banks making mortgage loans and retaining them on the balance sheet from a credit impulse perspective, do represent credit or narrow liquidity creation, regardless of Jerome Powell's statements that Fed purchases of MBS do not raise prices, because in reality, yep, they do. In that way, Fed and bank purchases of agency MBS extending credit continue to be extremely inflationary for house prices and for several other related components of the consumer price index basket. So while some goods will experience transitory inflation, including used cars, rentals, vacations, once this inflation fades away, it will be replaced by a persistent increase in home prices. Something even Goldman has acknowledged, adding that home price inflation will see an additional increase of at least 4% until the end of 2023. So, putting fading transitory inflation and upcoming rising housing inflation aside, the other big threat caused by these imbalances is that the U.S. money supply has been dangerously expanded for no reason, because at the end of the day, the Fed's policies didn't boost growth through inflation. But even though everyone has been warning the Fed about the flaws of the current policies, it's very likely that once a deflationary period starts to occur, the government will launch another major reflationary mega stimulus, which will also fail to stimulate benign inflation and keep fueling asset and price bubbles across the financial markets and the economy for another 3 to 6 months, in case they haven't already burst. Given that consumer demand is at all-time highs and the economy is effectively at risk of overheating, the government will have to find a very good excuse to engage in yet another multi-trillion money supply expansion. And as the government did in the past, and some are arguing that it will do again, they will use the health crisis and the spread of the Delta variant as justification to issue another expensive stimulus plan. Needless to say, this helicopter money will once again fail to create benign economic inflation. And every additional liquidity injection will only push us one step closer to uncontrolled asset price hyperinflation as soon as those trillions in newly created printed dollars start flowing right back into the financial market again. We're on the verge of a new era of painful price hikes and a stagnant economy, and we will be incredibly lucky if a catastrophic financial crisis doesn't burst in that process.